Now speaking, Julia Landrum, Vice President, Investor Relations. Thank you for joining us for our second quarter 2023 conference call. Our President and CEO, Bob Jordan, Executive Vice President and CFO, Tammy Romo, Executive Vice President and Chief Commercial Officer, Ryan Green, and Chief Operating Officer, Andrew Watterson are on the call with me today. We will be discussing our non-GAAP results, which exclude special items that are called out and reconciled to GAAP results in our press release. We will also make forward-looking statements, which are based on our current expectation of future performance, and our actual results could differ materially from expectations. For more information, please refer to the disclosures in our press release from this morning and visit our investor relations website. Now speaking, Bob Jordan, Executive Vice President, Corporate Services. Good morning, everyone. I am pleased to report that Southwest Airlines had a solid second quarter with record quarterly revenue of just over $7 billion and net income of $693 million, excluding special items. The demand environment for leisure travel has been resilient, resulting in solid bookings throughout the summer travel season. We expect $1 billion to $1.5 billion of pre-tax profit contribution in full year 2023 from our strategic initiatives outlined at our Investor Day last December. We anticipate record operating revenue and solid profits in third quarter 2023 and year-over-year margin expansion for full year 2023. Our employees have done an outstanding job getting customers and bags to their destinations, resulting in the lowest second quarter flight cancellation rate in the past 10 years. The cost outlook has increased for the year due to updates to our market wage rate accruals for open collective bargaining agreements. We are reflowing our order book to allow for orderly and measured growth and expect 70 deliveries in 2023. We are revamping our 2024 flight schedules to optimize for post-pandemic shifts in business travel and anticipate an incremental $500 million in pre-tax profit in 2024. We plan for first quarter 2024 capacity to be up in the range of 14% to 16% on a year-over-year basis and for a sequential deceleration in year-over-year growth in each quarter next year. We are on track for our winter operations plan, have the staffing plan in place to fully utilize our fleet by the end of the third quarter, and have the network restored by the end of the year. We are shifting our focus to restoring our industry-leading financial and operational performance, boosting our operational resilience, and making advances in our customer service through a focus on digital hospitality. Now speaking, Tammy Romo, Executive Vice President, Chief Financial Officer. Thank you. This quarter, Southwest Airlines had a solid operational and financial performance, with an all-time quarterly operating revenue record and double-digit operating margins each month. Fuel prices were slightly above previous guidance at $2.60 per gallon, and the company is 49% hedged for third quarter with an estimated fuel price of $2.60 to $2.80 per gallon, including 9 cents of hedging gains. Non-fuel cost increased 7.5% year-over-year due to higher labor costs, and the company estimates its third quarter CASM-ex to increase in the 3.5% to 6.5% range year-over-year. The company received 21 aircraft deliveries and retired 11-700 aircraft, ending the quarter with over 800 aircraft. CapEx outlook remains unchanged at approximately $3.5 billion, and capacity guidance remains unchanged at full year 2023 capacity up approximately 14% to 15%. In first quarter 2024 capacity up 14% to 16%. The company ended second quarter with cash and short-term investments of $12.2 billion, net of $67 million in debt repayments for the first half of the year, and declared another dividend in second quarter. The company plans to manage inflationary cost pressures, reflow its order book with Boeing to support orderly, measured and profitable growth, and rebalance and optimize its network to expand margins and return on invested capital in 2024. Now speaking, Ryan Green, Chief Commercial Officer. Our second quarter revenue results were strong, with operating revenue for the first half of 2023 consistently well above 2019 pre-pandemic levels. Operating revenue for second quarter was an all-time quarterly record of just over $7 billion. Unit revenue or RASM decreased 8.3% on a year-over-year basis on a capacity increase of 14.1%. We are seeing leisure booking and yield strength continue throughout the summer travel season with July revenue expected to also be a record. We had all-time record bookings the week of our fare sale with 3 booking days that were top 10 all-time records and included our record day for the most bookings ever taken. Corporate travel demand will remain lower than leisure for the foreseeable future, particularly compared with pre-pandemic. We are adjusting our network to support our imperative of industry-leading financial performance. We have more than 10% of our markets under development, which will normalize closer to pre-pandemic levels over the next 12 to 18 months. We also expect continued revenue contribution growth from our existing and fully implemented revenue initiatives. Finally, we are focused on widening our customer service advantage through prioritizations of a series of initiatives that will improve our digital hospitality and allow our customers to serve themselves in most cases. Now speaking, Andrew Watterson, Chief Operating Officer. Thank you, Ryan. I'm pleased to report that our employees delivered a remarkable operational performance in the second quarter despite challenging conditions. We achieved a flight completion factor of more than 99%, the highest second quarter performance in the past 10 years. Our on-time performance, long delays, early morning originators, turn compliance, flown as booked and trip net promoter score all showed solid year-over-year improvements. We are also making progress on our winter operations preparedness plan, which is on track to be fully implemented in fourth quarter 2023. We are already accepting delivery of new equipment and infrastructure, as well as completing software implementations. We are also conducting summer school to train new ramp agents on de-icing and new equipment. Lastly, we are committed to good faith negotiations to get new collective bargain agreements in place as quickly as possible and to compensate our employees with market wage rates. Wolfe Research analyst Scott Group inquired, what pressure did load factors experience in Q3, and how will further capacity growth affect RASM in Q4? Do you plan to moderate capacity growth? Ryan Green replied, in the second quarter, we achieved record operating revenue and saw an increase in average fares of 2%. Our domestic load factor was in line with our competitors. We expect July to be another record revenue month, despite a tough compare from last year due to pent-up demand. We are managing our revenue in a strong fare environment, which typically comes with a slight decrease in load factor. Bob Jordan replied, we've implemented a new revenue management system that will be fully operational this fall. It maximizes close-in demand and we're in a suboptimal environment as we restore our flying. We'll have all our aircraft in the air by the end of the third quarter, ahead of plan. We have over 10% of our network in development, with new cities and increased Hawaii flying. This is dragging average fare down by about $2 compared to pre-pandemic levels. We expect this to normalize by the end of next year. Wolfe Research analyst Scott Group inquired, what impact will network optimization have on capacity and CASM next year? Tammy Romo replied, yes, we are confident that the network redesign will be beneficial to both our revenues and costs. We are committed to driving our unit cost down and believe that the network design will help us achieve that goal. Bob Jordan replied, yes, the first quarter capacity is still significant. We anticipate that the restoration of aircraft and pilots will produce a lot of carryover into early next year. Additionally, we are optimizing our network to better match post-pandemic travel patterns. This includes reducing flights on Tuesdays and Wednesdays, managing early and late flights more efficiently, and other strategies to maximize revenue. Andrew Watterson replied, yes, we are making changes to our network in 4 buckets. Firstly, we are shifting our focus from short-haul business-heavy routes to more medium and long-haul routes with a lower business mix. Secondly, we are reducing Monday, Thursday, Friday flights by 7 to 10% depending on the season. Thirdly, we are adjusting the latest and earliest flights, which are typically our worst performers. Lastly, we are shifting our new city and Hawaii markets based on their seasonality and demand patterns. For example, at Midway in March of 24, we will have 225 departures compared to 229 in March of this year, a decrease of 4 trips. We are also changing frequencies for 26 city pairs, such as Midway to Columbus, which is decreasing from 6x to 4x, and Midway to Phoenix, which is increasing by 2 frequencies. Everyone is keeping their departure, but the composition is shifting slightly. Sarasota is a pure-play leisure destination, while Tampa and Phoenix are a combination of leisure and business. These small changes add up to a substantial change in our network. Raymond James analyst Savvy Seith inquired, what steps are necessary to return to 2019 pre-tax income levels and how long will it take? Tammy Romo replied, yes, Savvy. Our goal is to return to pre-pandemic levels of profitability in 2024. We are currently adjusting our network and optimizing our staffing levels to the current demand environment. We are also continuing to grow our network and modernize our fleet, which will contribute to our margin expansion. We are almost fully restored from the pandemic and are now focusing on producing year-over-year margin expansion for 2024. Raymond James analyst Savvy Seith inquired, does the labor accrual include any catch-up payments for prior years, such as ratification bonuses? Tammy Romo replied, Savvy, we have been actively adjusting our market rates to reflect current market conditions. We have taken into account all changes in the third quarter and factored them into our cost guidance. It is important to note that we have been accruing costs throughout the quarter. This should be kept in mind when comparing Southwest to other companies in the industry. Bob Jordan replied, yes, we are fully accrued for the most recent market. We have adjusted our full-year cost guidance from 2% to 4% down to 1% to 2%, which was mainly due to updating our accruals in response to the changing market. Raymond James analyst Savvy Seith inquired, what drove the increase in labor costs this quarter, all labor groups or pilot shortages? Bob Jordan replied, we have seen an increase in our accruals due to the market movement. We are now fully up to date with the market and have some good news to share. This morning, we received ratification of a new agreement with our mechanics and related employees in AMFA, extending the contract for 4 years through 2027. This is the 7th agreement in the last 9 months. Evercore IC analyst Duane Pfennigwerth inquired, what geographic variations have you seen in the U.S. that have impacted your third quarter guidance? Why did you decide to start making network changes in January rather than the fourth quarter? Ryan Green replied, yes, Duane. Ryan here. The Hawaii franchise is part of our developing markets and we're pleased with its performance. Load factors and yields are both high. We've made some changes to the Intracal network, and despite the West Coast's slower recovery, it's doing well. Leisure-based markets like Florida are also performing well. As we bring back the network, there are some markets with outsized capacity growth that we're working to absorb. Southwest Airlines has a diverse domestic footprint which helps us weather different economic cycles better than our peers. Andrew Watterson replied, Duane, I wanted to emphasize that we are taking a measured approach to our network changes. We made adjustments in September and have been monitoring the forward bookings to ensure that our changes are having the desired effect. We then made full adjustments starting in Q1, with the exception of seasonal adjustments which will be implemented as the season rolls around. Bob Jordan replied, Duane, we understand the disruption that wholesale changes to our customers' schedules can cause. We committed to not making such changes, and January was the first opportunity to enact the changes we had planned. Evercore IC analyst Duane Pfennigwerth inquired, can you provide us with an estimate of the magnitude of the excess training and reliability investments that are unlikely to reoccur or wind down next year? Tammy Romo replied, Duane, we've incurred $100 million to $150 million in one-time costs related to operational disruptions this year. We'll provide more details on our training plans and capacity plans once our 2024 plan is finalized. J.P. Morgan Chase & Company analyst Jamie Baker inquired, Tammy, what factors are driving the ex-fuel CASM to remain relatively flat from Q3 to Q4? Tammy Romo replied, Jamie, capacity is a key factor in our plans going forward. We are continuing to add back capacity and this will be the primary driver of our progress. J.P. Morgan Chase & Company analyst Jamie Baker inquired, have you considered that the Southwest brand may have been damaged last December, and if so, how does this factor into changes in travel patterns? Bob Jordan replied, yes, absolutely. We are seeing strong demand for our brand and product across the board. Our fall sale saw record booking days, and we have seen significant market share gains in the business sector. We are tracking customer trust, preferences, and other metrics, and they are all heading in the right direction. Overall, we had record operating revenues, passengers, and flights in the quarter, indicating that demand for our brand and product remains strong. Ryan Green replied, yes, following the disruption event, our brand tracking research has shown that sentiment towards Southwest Airlines has rebounded to normal levels. Demand for our services remains strong, with record revenue and rapid reward acquisitions in the second quarter. Additionally, travel patterns have not changed significantly since prior to the disruption event, and we are continuing to gain market share in the managed business space. Melius research analyst Connor Cunningham inquired, why is mid-single-digit growth the right number for Southwest given their current order book, open labor contracts, and potential to retire planes? Tammy Romo replied, we believe we have growth opportunities and have made investments during the pandemic to grow our route network. We have a larger than normal amount of capacity in development markets, which are progressing and trending in line with our expectations. We have no plans to pull back on the development of these markets as they are good for Southwest over the long term and we have additional opportunities in our stronghold markets. Based on our assessment of our growth opportunities, we believe that supports mid-single-digit ASM growth. We are determined to drive returns on invested capital and have a flexible order book and fleet plan should we need to adjust. We are focused on delivering a 2024 plan that will deliver margin expansion and return on invested capital. Bob Jordan replied, Connor, I'm proud of the fact that we've been able to open our aircraft and restore our network by the end of the year. However, we still need to optimize our resource usage and efficiency. We have plenty of opportunities for mid-single-digit growth in cities like Denver, Austin, and Nashville, where there is high demand for our product. We have gates coming online and a lot of brand strength. We need to continue to boost revenues and returns, and we have the flexibility to do so. Melius research analyst Connor Cunningham inquired, what is the implied capacity growth for 2024 and is that the low watermark we should expect? Tammy Romo replied, the carryover to next year will have an impact of approximately 7 points. Jefferies analyst Sheila Kahyaoglu inquired, given the $500 million benefit from network optimization, what is the expected EBIT growth for 2024 given the projected decrease in RASM and potential increase in CASM-ex? Bob Jordan replied, Sheila, we are confident that our initiatives and network changes will contribute $1 billion to $1.5 billion in EBIT and an additional $500 million in value. We are working on a plan to achieve margin expansion in 2024 and will share it with you in the fall. Airline reporter Alexander Scores inquired, what is the status of Southwest pilot contract negotiations and are they committed to meeting the new pay standards and benefits? Bob Jordan replied, thanks for the question. We are in complex negotiations with all of our groups that have open contracts. We are meeting regularly with SWAPA and remain hopeful for progress. The strike authorization vote is a NMB-defined process, and there is no imminent strike. We want to make progress well ahead of any steps that would lead to a strike, and our goal is to close all contracts, including that with our pilots. Andrew Watterson replied, I'd say that the pilots market is strong right now. This is reflected in the wage rates, which often get the headlines. However, what's really driving the negotiations are the non-wage components, such as scheduling rules, which can increase costs for the company but also improve the quality of life for the pilots. These rules can be complex and time-consuming to write out and model, so it takes longer than expected to reach an agreement. Airline reporter Mary Schlangenstein inquired, can you please clarify when the winter plan will be in place and if the $100 million to $150 million cost is for post-disruption activities? Andrew Watterson replied, we anticipate reporting our third quarter earnings in October. We are on track with our timeline and encouraged by the results we have seen so far. Tammy Romo replied, yes, Mary. Could you please repeat your question about the $100 million to $150 million? Airline reporter Mary Schlangenstein inquired, can you provide an estimate of the total cost incurred due to the disruptions? Tammy Romo replied, our current estimate of one-time costs is that they will remain at the same level as this year. However, some of the investments we made this year may carry over into next year, particularly in technology. This is our best guess at this time. Bob Jordan replied, we provided gratitude pay and customer reimbursements this year due to the disruption. These one-time expenses will not be seen in our 24 earnings. Tammy Romo replied, Mary, I want to remind you that we had plans in place to modernize our operations prior to the event. These investments are part of what I was referring to earlier and will continue as planned, all of which is reflected in our guidance. Air travel reporter Don Gilbertson inquired, what impact has the leisure travel surge had on Southwest's demand for upgraded boarding, EarlyBird boarding, and Business Select? Additionally, what is the strategy behind the increased pitches to buy A-list status? Ryan Green replied, Don, you're right that some of our competitors have seen a tailwind from premium revenue. We don't participate in that to the same degree, but our ancillary revenue was a record in Q2. Upgraded boarding take rates have tripled since we added the ability to purchase it on mobile devices, and we've been able to maintain and even grow the price. We also run campaigns for customers to top off their tier qualifying points to get A-list status, which is something we've done historically. Air travel reporter Don Gilbertson inquired, can you provide an update on EarlyBird and upgraded boarding revenue? Ryan Green replied, yes, our boarding products generate hundreds of millions of dollars in annual revenue and we just had a record second quarter. Revenues are continuing to grow. Tammy Romo replied, yes, EarlyBird alone generated over $100 million in the second quarter. Airline reporter Leslie Josephs inquired, what was the RASM decline for Q3 and how does it compare to 2022? Are there any sharp drop-offs after mid-August? Ryan Green replied, yes, Leslie, there is a RASM headwind due to capacity growth that's above seasonal norms in the third quarter. However, we are anticipating a record third quarter revenue and have more bookings in place than at the same point in time in the second quarter. We had an all-time record fare sale in June for our fall travel, with top 10 booking days and our all-time record for bookings taken in a single day. July is roughly booked at this point and the strong fare environment from the second quarter has persisted into July. Despite the RASM deceleration, our domestic RASM looks favorable compared to our peers. Air travel reporter Allison Sider inquired, what is the attrition rate of pilots in the last couple of months and what are the reasons for their departure? Andrew Watterson replied, the pilot market is certainly hot right now. We've seen a record year for pilot hiring, but also a modest increase in pilot attrition. This hasn't been enough to affect our plans for flying this year or next. Pilots often job hop around the industry to maximize their personal gain, and we understand that. We saw a spike in attrition in the second quarter, but it's now starting to tail off. Bob Jordan replied, yes, the attrition rate is higher than normal due to the current pilot market being the hottest in history. We are still on track to hire 1,700 pilots this year and have our entire fleet back up and running by the end of the third quarter, which is ahead of our original plan. Despite the higher attrition rate, I feel confident that we will meet our goals. Senior aviation business reporter David Slotnick inquired, what impact do you expect capacity growth and pricing power to have on RASM headwinds in the fall? Are you expecting a return to pre-pandemic shoulder season seasonality? Ryan Green replied, the demand environment for leisure travel remains strong and we have a solid base of bookings in place for the third quarter. We expect yields to be weaker quarter over quarter, but this is setting up for another record revenue quarter. Bob Jordan replied, "Our fare performance in the second quarter was impacted by a $300 million breakage change from last year. This means that when looking at average fares year over year, they appear to be down 2.7%. However, when normalizing for the breakage impact, fares are actually up 2.2%. Senior aviation business reporter David Slotnick inquired, "Do you anticipate a return of the shoulder season this fall?" Ryan Green replied, "I'm confident that our third quarter will be strong. Demand is high and bookings are in place for the fall, indicating a successful quarter." Linda Rutherford replied, "If you all have any other follow-up questions, you can reach our communications team through our media website portal. Thank you all so much."